For decades, the story of the United Kingdom's housing market has been told as a story of inevitability. Prices rise, pause briefly, and then rise again. Generations have grown up believing that property ownership is not simply a place to live, but a guarantee of long-term security, a substitute for pensions, and a vehicle for wealth accumulation. This belief has survived recessions, political upheavals, and global financial crises. Yet, as the middle of the 2020s approaches, the foundations of that story are beginning to fracture. The years following the global financial crisis of 2008 reshaped housing in Britain in profound ways. Ultra-low interest rates, quantitative easing, and a chronic shortage of new homes created an environment in which borrowing became cheap, risk appeared minimal, and rising prices felt almost natural. By the time the pandemic arrived, this model was already deeply entrenched. What followed between 2020 and 2022 was an extraordinary surge in borrowing, fueled by historically low mortgage rates, stamp duty incentives, and a renewed desire for space. Prices accelerated rapidly across much of the country, often detaching from local wages and underlying economic realities. But markets built on cheap credit are inherently fragile. As inflation surged and monetary policy tightened, the era of effortless borrowing came to an abrupt end. Interest rates rose at a pace not seen for decades, and with them came a fundamental reassessment of affordability. Millions of households who took on debt at 1 or 2% interest rates now face refinancing at double or triple that cost. Investors who relied on capital appreciation to compensate for thin rental yields are discovering that the arithmetic no longer works. What once looked like a stable system is revealing itself to be highly sensitive to even modest economic pressure. Within this broader national adjustment, the year 2026 emerges as a critical moment. It is the point at which the delayed effects of post-pandemic borrowing, higher interest rates, and stretched household finances are expected to converge. This does not mean a uniform collapse across the country. The UK housing market has never behaved as a single entity. It is fragmented, localized, and deeply shaped by regional economies, demographics, and patterns of ownership. Some cities are structurally better placed to absorb shocks, others are not. What follows is an examination of 10 UK cities where housing markets appear most exposed to significant price corrections by 2026. These are not predictions rooted in short-term volatility or pessimism. They are grounded in structural indicators that have historically preceded housing downturns, price-to-income ratios that exceed sustainable levels, heavy reliance on investor demand, large pipelines of new supply, weak wage growth, and high exposure to mortgage refinancing risk. In these places, the coming adjustment is likely to be sharper, more prolonged, and more visible. Number 1. London. London sits at the center of this story, both literally and symbolically. For much of the past 3 decades, the capital has been treated as a market apart, insulated by its global status, international demand, and chronic undersupply. And yet the London that approaches 2026 is not the London of the early 2010s. The forces that once propelled prices upward are weakening, while new pressures are emerging. The vulnerability in London is not concentrated in its most exclusive postcodes, but in the outer boroughs and commuter-oriented districts that experienced rapid growth during the low-rate era. These areas attracted highly leveraged owner-occupiers and buy-to-let investors seeking relative affordability and strong capital appreciation. As hybrid and remote working reduce the premium attached to proximity to central offices, the economic logic underpinning these price rises is being eroded. At the same time, Tax changes have dampened international investor demand, while higher stamp duty costs have frozen transaction volumes. By 2026, a large cohort of London homeowners will be refinancing mortgages taken out at the peak of cheap credit. For many, even a small increase in monthly payments will represent a serious strain. In such conditions, forced sales are no longer a theoretical risk. London will remain a global city, but its housing market is entering a phase of fragmentation, where location, energy efficiency, and buyer profile matter more than ever before. Number 2. Manchester. Manchester tells a different but equally revealing story. Over the past decade, the city has been celebrated as a model of regional regeneration. Tower cranes reshaped its skyline, population growth surged, and property prices rose at a pace that rivaled parts of the capital. Yet much of this growth was driven not by local owner-occupiers, but by investors, both domestic and international, drawn by promises of high yields and long-term appreciation. In many parts of Manchester, house prices now stand far above what local wages can comfortably support. This matters because investor-led markets behave differently from owner-occupier markets. When confidence falters, investors tend to move quickly, often in the same direction. The city centre, in particular, faces a substantial pipeline of new apartment developments, many conceived during a period of cheap finance and optimistic assumptions about rental growth. As interest rates rise and margins narrow, the risk of a coordinated investor exit increases. If large numbers of near-identical flats return to the market simultaneously, prices will come under intense pressure. Manchester's long-term economic prospects remain strong, but the adjustment in investor-heavy segments is likely to be sharp and painful. Number 3. Birmingham. Birmingham's housing market has been shaped by ambition and expectation. For years, regeneration plans and major infrastructure projects have fueled optimism about the city's future. Yet optimism alone cannot sustain prices indefinitely. Much of the anticipated growth has already been priced into the market, leaving little room for disappointment. The city has seen extensive new build activity, particularly in central areas. While this has modernized the housing stock, it has also increased supply in a context where wage growth remains modest. Delays to major infrastructure projects and broader economic uncertainty have begun to undermine confidence. By 2026, Birmingham risks facing an uncomfortable combination of oversupply and weakening demand, a classic precursor to price correction. Number 4. Leeds. Leeds offers another example of how concentrated market structures create vulnerability. As a regional financial and legal hub, the city has attracted young professionals and investors alike. But its housing market has become increasingly skewed towards city centre flats purchased for rental income. Rising service charges, maintenance costs, and energy efficiency requirements have eroded returns, while wage growth has failed to keep pace with price inflation. As first-time buyers are priced out, investors increasingly find themselves selling to other investors, a fragile and unsustainable dynamic. The likely outcome is not a sudden collapse, but a prolonged period of downward pressure on flat prices, even as suburban family housing remains relatively resilient. Number 5. Nottingham. In Nottingham, the housing market's dependence on student demand introduces a different set of risks. Universities have driven investment in HMOs and purpose-built student accommodation, often supported by leveraged financing. But demographic change, regulatory tightening, and uncertainty over international student numbers threaten this model. As financing costs rise, marginal investors may find themselves trapped in assets with limited exit options, increasing the likelihood of gradual but persistent price declines. Number 6. Liverpool. Liverpool's experience highlights the dangers of speculation without depth. The city has attracted significant overseas investment, often based on optimistic projections of regeneration-led growth. While some areas have improved substantially, owner-occupier demand remains weak relative to supply. Many developments consist of small flats with narrow appeal, making them vulnerable if investor sentiment turns. In such conditions, price declines can be uneven but severe. Number 7. Sheffield. Sheffield presents a quieter risk. The city has not experienced dramatic price inflation, but this does not imply safety. Weak wage growth, limited inward migration, and uncertain employment prospects create an environment where affordability pressures can translate into stagnation and real terms price declines over an extended period. Number 7. Sheffield. Sheffield presents a quieter risk. Leicester's challenge lies in the gap between affordability and income growth. Prices have risen, but without the support of high-paying sectors capable of sustaining them. While the city benefits from diversity and a broad industrial base, the absence of strong wage growth increases the likelihood of a slow but persistent downturn. Number 9. Coventry. Coventry's recent housing growth has been driven largely by spillover demand from more expensive neighboring cities. Such demand is inherently fragile and highly sensitive to interest rates. As borrowing costs rise and spillover demand recedes, prices are likely to correct, particularly in commuter-focused developments. Number 10. Milton Keynes. Milton Keynes exemplifies the risks associated with rapid expansion. High levels of new construction, combined with heavy household debt exposure, leave the market vulnerable if demand slows. The weakening of the traditional commuter premium due to remote working further undermines price support. Taken together, these cities illustrate a broader truth about the UK housing market as it approaches 2026. This is not a story of uniform collapse, but of divergence. Markets that have become detached from income, over-reliant on investors, or exposed to refinancing shocks are entering a period of reckoning. Others, anchored by strong local economies and sustainable demand, will fare better. The era in which rising house prices could be assumed is drawing to a close. Housing markets are cyclical, local, and ultimately constrained by affordability. The cities most exposed to correction are those that forgot this basic reality. As the adjustment unfolds, the lesson for buyers, investors, and policymakers alike is clear stability. In housing is not built on speculation, but on fundamentals. On the northern edge of Greater Manchester, the picture is markedly different. In towns such as Rochdale, Bury, and Haywood, house prices have continued to rise, supported by relative affordability and strong owner-occupier demand. Buyers priced out of central Manchester are moving north in search of space and value, while transport links keep these areas connected to regional jobs. Unlike investor-dominated city centre markets, demand here is rooted in people buying homes to live in, not to flip, giving prices greater resilience despite wider economic pressures.